Calcom Vision Limited. Today we are going to do the analysis of this Microcap company which is into manufacturing of electrical products like bulbs, lights. So this sector has a lot of tailwinds because the manufacturing is gradually shifting from China to India. People are preferring Indian manufacturers, and the government is also supporting this sector very much by giving several subsidies and PLI schemes. Hello friends, a very warm welcome to my channel. If you are new to the channel, please do subscribe and hit the bell icon to get all the new notifications of any uploads. And if you are not a part of our Telegram channel, do join today as we discuss daily the market analysis and a lot of interesting stuff. So let's begin the analysis of Calcom Vision Limited. So Calcom Vision Limited is mainly into the manufacturing of electric lights and bulbs. In the lighting segment, the company manufactures various types of electric lights, the LED, smart lights and several other products. So this group as such is into electric or electronic products manufacturing. Since more than 45 years, they've been manufacturing several other products like televisions, home appliances also. And they, in the lighting segment, they have developed more than 150 products in the last 10 years as they've been focusing on the lights in the recent decade. What does this company do is they don't manufacture and sell in their own brand name. They do contract manufacturing and sells to the other OEMs. So other companies like Panasonic, Usha and other brands get their products manufactured from Calcom Vision under their own brand name. So this company has backward integration and they can manufacture right from the design stage till the end of dispatch. So they have all the facilities in-house, but some of the components in their manufacturing process are imported from outside India. So let's understand a brief history of the company to know them better. They started this business in 1976 as they started exporting calculators to countries like Russia and US. So they started with a altogether different product. In 1982 they ventured into manufacturing of televisions, and in 1986 they started their in-house plastic mold development unit. In 1990 they got the company listed on the stock exchange and they started component manufacturing in collaboration of Samsung. In 1995 they started their in-house R&D center, and in 1999 they started manufacturing some of the home appliances like vacuum cleaners, mixer grinders, etc. Then in the further years of 2002 and 2003 they developed several new types of televisions, and they also started exports to European countries in 2005. In 2009 they diversified into their latest field, which was the lighting products, and in 2013 they started the LED lights manufacturing. In 2014 they further explored different types of lights and they started manufacturing high-end stage lights with the collaboration of a company in Germany. In 2016 they also started manufacturing air purifiers. 2019 they further diversified into newer lights like the architectural lights, which is for the outdoor, and the floodlights. And their recent development was starting of manufacturing of bulbs, the LED bulbs, which are a high volume product but a slightly lower margin product when compared to their earlier products. Now let's understand who is behind the company. The company is headed by the chairman and managing director Mr. Sushil Kumar Malik, who has more than 4 decades of experience in the electronics manufacturing business. He has done his electronics engineering from Delhi College of Engineering. He has done his MBA from FMS Delhi, which is also a renowned college in India. And he is the founder of the company, so he has been associated right from the inception. Now let's understand the business of the company. The company is into a very simple business. They are a contract manufacturer and they manufacture products for the other OEMs, which is the original equipment manufacturers. Now who are the OEMs? Brands who are into manufacturing and selling of electric and electronic products like Panasonic, Usha and several other brands which we know. So they get their products manufactured in the form of contract manufacturing through Calcom Vision and they sell it in their own brand name. So what can be done? They would give a design and other specifications. Calcom Vision manufactures for them and they will sell those products. There will be high quality checks, and to supply to these companies is not easy. So after several trials and approvals, one vendor gets approved. So Calcom already has such approvals from various big brands in the country. So this gives this company an economic or a competitive edge. Even if a brand wants to develop a new product, the company also does the R&D and design. So they can give an idea of a product to Calcom. They can do research on the idea, come up with prototypes and different designs and take approval from the OEM and then manufacture the product. So they are vertically integrated also. These are some of the products which the company manufactures. In the LED bulbs, they have complete range from 0.5 watts to 50 watts. So various size, shapes and different specifications they manufacture in the LED segment. When it comes to the domestic use, also they have products, and they have products related to the industrial use, which is used in different high-end construction infrastructures. They are also into decorative and outdoor lighting, so these kind of strip lights and focus lights also they manufacture. They are also manufacturing street lights, which in itself is a big segment. Now, after excelling in the LED lights categories, in the LED bulbs categories, now the company is working on starting the fans manufacturing. In fans manufacturing, they are specifically focusing on the BLDC fans. So the brushless direct current fans are the fans which consume lesser power, so your electricity bills will be lesser, and the lifespan or the life of usage of the fan will be much longer than the traditional fans. So the company is already doing research on this product, and they are just waiting for a company to collaborate with them for supplying of motors. So once that is done, they will start assembling or manufacturing the BLDC fans in India. So this will open further doors for the company to work with newer brands and increase their product size in terms of volume, value, as well as in terms of margins. In lights, the company is further innovating and diversifying into new products like the smart lights, LED floodlights, etc. Presently, the annual installed capacity of the LED bulbs is about 84 million per annum, pieces per annum, and the LED battens, which are the lights, are 12 million pieces per annum. So these are some very big brands which the company is manufacturing on their behalf, like Panasonic, Jaguar, Walmart, Havells, Bajaj. So you can see that these kind of big brands trust Calcom Vision for their products quality. When you look at the segment-wise contribution of revenue, a majority of their revenue, close to 70%, now comes from the bulbs, which is a recently started segment. So as we have discussed, this is a high volume value segment, so that their contribution to the revenue has very fast become such large. The other old products which the company is not much concentrating on, the home appliances, TVs and other stuff, is less than 10%. The LED drivers contribute about 2%, and LED bantons, which is the lighting segment, constitutes about 18%. So the Indian lighting industry is witnessing high growth, and it is expected to reach a size of about $5 billion in the next 5 years, and the growth in this market is expected to be somewhere around 24% CAGR up to 2026. So the industry itself is growing in double digits, or in fact more than 20%. There is also a report that in spite of the Indian consumption, the Indian lighting manufacturing industry will grow to such a level that India will start exporting to the other countries like the Chinese do. So that's also a huge market, global market for the Indian manufacturers. So what will lead to the growth of this industry in the next few years is the government and the indigenous manufacturing will promote exports. The government will encourage companies to manufacture these products in India itself. So the Make in India or Atmanirbhar Bharat initiatives. The rural electrification will increase the requirement or demand for these products. People will focus more on energy efficiency. So new products will be developed in this segment, and the old products which are inefficient in terms of energy will be replaced with the new products, creating more demand. There are several schemes like Ujala scheme, which is started by the government, which will also create demand for these products. And as the people move from rural to urban areas, more consumption of these products will be increased. China Plus One theme is excellently playing out in this industry, as maximum concentration of the Indian OEMs is to shift the production of China to India itself with the Indian manufacturers. And other than the Indian OEMs, there will be several global brands which also will look at India as an alternative to China to manufacture these products for them. Now, let's talk about the competition in this space. This sector or industry has very high competition. Although there may be lesser players in the listed category, but in the unlisted category also there are several fragmented people who are manufacturing for these brands. Other than the Indian manufacturers, they compete with the Chinese manufacturers, because these kind of contract manufacturers are dependent on brands for a majority or large size of their orders. The brand generally don't give these people higher margins, because the brand themselves, they have the capabilities to set up the manufacturing facilities in-house. But in certain cases, they don't want to take the headache, or they want to outsource a part of their manufacturing outside. So because of that, they do it. And because of these reasons, they are not willing to pay high margins to these contract manufacturers. So that's why whether it is Calcom Vision or any other contract manufacturer, they operate with a very low margin. So it's a highly competitive business and a low margin business for them. but the volumes are huge. So a few players in the listed category where the company competes with is Dixon, Vandar Electricals and the HPL Electric Power. There are several new IPOs of companies which have come recently also, which are venturing into this segment. So the space is going to be highly competitive going further also. Now, in spite of the competition, what could be a competitive edge of this company? The company also has R&D division, so they can do research and design prototypes of different products for the companies. They have a technical expertise to manufacture several products because they have been working in this industry for the 4 decades. In terms of cost, the older manufacturers will have that advantage because they already have the entire supply chain and manufacturing facilities ready compared to a new entrant. In terms of manufacturing infrastructure, they have a well-developed infrastructure because existing big brands have already approved their facilities as well as their products. They already have approvals from all these bigger brands, which is not easy for a newcomer to crack or get approvals soon. Recently, some institutional investors have entered into the company, so they will have their continued support in terms of funding going further. Why are we discussing this point? Is because this company is still a microcap company, so they will require more funds to scale up. So because of all these things, this company will have a slight edge when compared to the others in the same industry. Now, what is the growth outlook of the company going forward? Their monthly capacity of LED bulbs, they have increased from about 3 million to 7 million, and going further they will increase this further to 10 million. So they are continuously doing capex. The management is giving a guidance of about 50% growth in FY23, so they will do a revenue of about 150 crores in this year, and going further they will try to maintain the similar growth trajectory. They are entering into BLDC fan manufacturing, as we have discussed, which will open up doors of new products and industries for this company. In their existing segment, they are also venturing into newer products like smart bulbs and outdoor lightings, and they are continuously talking with several new brands to get more contracts for them. They have applied for their PLI scheme and they have gotten approval, so they will get some benefit as they do the manufacturing of a few lakhs every year, which will support their bottom line. The company is focusing on the import substituted products, so whichever products are imported from China, they are trying to substitute those products and manufacture in India itself. They have shown consistent growth in the last 2-3 years, although historically the performance has not been that great. And they are also doing some backward integration as they have set up an in-house plastic extrusion plant. The company is also focusing on automation of their products, which will increase the quality of the product as well as the operating efficiencies will improve, leading to better margins. So these are several initiatives which the company is taking for their fast growth in the near future and for better operating efficiencies. Recently, the company has got funding from some institutional investors like MIT as well as Old Bridge, which are renowned names in the investors category. Now, in spite of these advantages or growth plans, what are the risks which the company has to face? There is intense competition in this space. The company has to be on toes for competing with them. The commodity prices inflation will impact the margins of the company as this industry operates on a very low margin. So this is something which we should monitor. There is a bit of liquidity risk in the company because I don't see much of free cash flows in the company, and the company is bound to raise more funds in the form of equity or debt for their growth. The company has to continuously work on keeping their technology up to date. Otherwise, the OEMs would not prefer to get the things manufactured from them. There is customer concentration risk as majority of their revenue comes from mainly 2 brands, which is Panasonic and Usha, and further diversification would reduce this kind of risk. The company also depends on import of more than 50% of their components from China. So there is again a risk of import of these kind of materials. So these are the different risks which the company has to face in their business, and as investors also we have to closely monitor whether these risks are impacting their business going further. Now, after understanding the business, let's talk about the financial analysis. The revenue in the last 5 years has been steadily growing. They have shown exponential growth in revenue from about 25 crores to 138 crores in the trailing 12 months. EBITDA is more or less stagnant. So this is where I want your attention to be. The top line of the company is growing pretty well, but in terms of bottom line, the company is not doing so well. The EBITDA levels are more or less stagnant. The EBITDA margin is also not consistently improving. It is range bound, or in fact, it is slightly lower than before. So it's again a low margin business. We have to see what could be the sustainable margins of the company going forward. In terms of profit after tax, the company is hardly making any profit in spite of doing more than 100 crores revenue. In terms of profit margins, again the margins have been falling because in terms of bottom line, the performance is not up to the mark. So what we observe when we look at the P&L of the company is the company is more focused on growing their top line, and they are not focusing more on maintaining the margins right now. So we have to see whether this is a temporary phenomenon and whether the company is focusing more on the growth right now, and they will also consider the profitability in the coming quarters. That judgment we have to take when we look at the performance in the coming 2 to 4 quarters. When we look at the balance sheet, the share capital has recently gone up to 13 crores. This is because there was a preferential issue where the promoters converted their unsecured loans to equity capital, as well as the preferential shares were allotted to the institutional investors, which are MIT, and this was done at a price of about 73 rupees in FY22. The reserves have now become positive because of the recent performance of the company, but historically, if you leave this last 4-5 years and see the history, the last couple of decades, the company's performance was not up to the mark. So in such kind of companies, what happens, another risk we should look at as investors is the execution risk, because they should not overcommit and under-deliver. In terms of borrowings, the borrowings have slightly gone up. They have gone up to about 18-19 crores, and the debt equity ratio is somewhere around 0.44. So why are the borrowings growing? Because there is no free cash flow in the company. So the company is borrowing funds and also raising preferential capital to keep up with their growth. Trade payables are more or less in line with the sales growth of the company, so that's not a problem. Fixed assets have increased because the company is doing capacity expansions for their existing and new products. The inventory is more or less around 20 crores, and the inventory days have slightly improved from about 200 days to somewhere around 100 days in FY22. In terms of trade receivables, the debtors have gone up to about 20 crores. The debtor days have increased from about 1 month to 2 to 2.5 months now. We have to see whether this range of 2 months or 2.5 months of debtor days is maintained, or this gets further worsened and this goes up to 3 to 4 months. If this further goes up, it would not be a good sign, as it depicts that the company is becoming too lenient for payments with their debtors in order to get more contracts or revenue. Cash, there's not much cash on the balance sheet of the company because the entire funds are being used for the growth of the company. The operating cash flow itself has remained negative in several years, so I'm not very happy with the cash flow position of the company, and obviously free cash flow will also be negative where the operating cash flow itself is negative, and that's why there could be a liquidity risk in the company if the profitability, if the margins, if the cash flows of the company don't improve going forward. As the profitability is very low, the return ratios obviously are low for the company, which is again not a good sign from an investor's point of view. The auditors of the company are Suresh Chandra and Associates. The ROE is also low. The company doesn't pay any dividend because they are struggling with the cash flow position. The director's remuneration is more than 1 crores. Normally it's not very high, but for a company of this size, which is not generating much of profits, I felt this figure is slightly on the higher side. I found a transaction in the related parties which is amounting to about 5.73 crores, and it was written reimbursement of trainee, so I'm not very sure for what this transaction is. Again, a payment of 5.73 crore to a related party is a massive payment for a company of this size because it erodes the complete profitability of the company. So we need to find out by getting in touch with the management as to what this payment exactly is. The group also has other unlisted companies, and one of which is Calcom Electronics Limited. So we also have to find out what this company does, whether they are manufacturing same products which this company is doing, and what are the transactions or nature of relationship between Calcom Electronics Limited and Calcom Vision Limited. So when we get these kind of things clarified from the management, only then we will be more confident as investors to invest in the company. The shareholding pattern, if you look at, promoters hold about 67%, which is pretty decent, and this dilution happened because they brought institutional investors recently, which is MIT, which holds about 6.26%. Public holds about 22%, DII is about 3.82%, and FII 6.96%. Now when you look at the valuations, the market cap is just about 183 crores, so it's a very small company having a face value of 10 share. The revenue is around 130 crores, so they would do roughly about 150 crores in FY23. So in terms of market cap to sales, the valuations are not expensive. The EBITDA margins are low. PE is about 52 because the profitability is very low in the company. The PE definitely looks very high. In terms of price to book ratio also, it trades at more than 3x. So Overall, the valuations looking at the present performance of the company are fully priced. But if the profitability of the company is improved, if the return ratios are improved, if the cash flow position is improved going forward, then these valuations will get easily justified. If you are an aggressive investor and if you want to take a call or take a chance of investing in such companies and quite hopeful that the performance in the bottom line as well as cash flows will come in the future, then looking at the top line, you can start investing. If you are somebody who doesn't want to be very aggressive and would want to see the performance on the paper, in the financials, in the cash flow of the company, then you should be waiting for the company to show that kind of a performance before you invest. If you look at the chart for many years, as the company was underperforming, there was no growth in the share price. This is the monthly chart I have taken for you to see a longer horizon. And in the last couple of years itself, the stock price has given a very sharp movement. One of the reasons for this is entry of the institutional investors, which have a good brand name in the investors community. After giving this recent rally, the stock is more or less sideways and it is taking support at somewhere around 80 kind of levels. So near the base of 80-90 kind of levels, the stock is taking support, and as investor, you can wait for a dip to enter the stock at these kind of base levels. So if you enter at lower levels in such companies, what happens? Because you yourself are a little doubtful of the company's execution. So your downside is more or less protected if you buy during a panic selling at lower levels in such companies. So this is about Calcom Vision. I have tried to bring out the company's business in detailed and a very simplistic manner, and also tried to be totally unbiased and discuss the positives and negatives of the company. To summarize, the sector in which the company is operating is a very good sector with a lot of government support and a lot of high growth tailwinds. The company's growth in the last 4-5 years has been exceptional, so the top line is growing very well. They have already tie-ups or associations with very big brands in the country, so these kind of associations give them an edge over the others. They have highly efficient people and in-house research and development to manufacture whatever their customer wants. So these are the different thesis points of investing in the company. If you look at the antithesis points, there will be intense competition in this sector and they will have to operate at very low margins. In the past, the margins of the company have been totally inconsistent, so still we don't have clarity what would be the normalized margins going forward. There are some related party transactions where we need to get clarity on. There could be an execution risk in the company as what they say and what they achieve, especially in terms of bottom line, we have to closely look for. There could be a liquidity risk because the cash flows are still negative for the company, and there is also a risk of customer concentration as they are dependent on a bunch of customers for majority of their revenue. So if at all one customer goes, the revenue will be drastically impacted. So keep these things in mind before you take an investment decision in this company. I hope you like the analysis of Calcom Vision. If you like it, hit the like button and subscribe to the channel. If you want me to make videos on your favorite companies, whether it's a small or big company, do mention those names in the comments below. Thank you for watching and have a wonderful day.